Hey everyone, Mike Sather here, back from vacation, rested, recharged, and ready to jump back into the market talk. I took about a week off, got some much needed R&R, and of course the moment I step away, the Fed stirs things up again. So today I'm breaking down what's happening with interest rates, the mortgage market, and how this mix of rate cuts, rising yields, and a government shutdown could affect you. Because even though the Fed might be shut down, I'm not. So let's get right into it. Last month, the Fed finally cut rates by 0.25%, the first move lower after holding steady for a long stretch. But instead of calming things down, that rate cut seems to have opened a debate inside the Fed itself. Go figure, right? Here's what's actually going on. Some officials, like Kansas City Fed President Jeff Schmid, are saying rates are appropriately calibrated. That's Fed speak for we're good right where we're at, no reason to rush to cut again. Others, including some of the more dovish members, want to keep lowering rates because inflation is moderating and parts of the labor market are softening. So you've basically got two camps, one cautious, one more aggressive. And the split matters because it means the path forward isn't clear. Every new piece of data, whether it's jobs, inflation, or consumer sentiment, has the power to swing expectations. That's why you might see one headline saying, more cuts ahead, and another the next day warning the Feds may pause. In other words, the Fed itself isn't completely sure. Now let's talk about what most people actually care about. Mortgage interest rates. Of course, right? Even after the Fed cut its short-term rate, mortgage rates have crept a little bit higher. The average 30-year fixed is hovering around 6.34%, and that's the second straight week it's ticked up a bit. So you might be thinking, wait a minute, shouldn't a Fed cut push mortgage rates down? Well, here's the key. Mortgage rates don't follow the Fed directly. They move mostly with long-term bond yields, especially the 10-year Treasury. And right now, those yields have been rising. Why? Well, for a mix of reasons. Investors expect more government borrowing during the shutdown, inflation data is mixed, and markets are uncertain about what the Fed will actually do next. That combination pushes long-term yields up, and that keeps mortgage rates elevated. So that explains it, right? So if you're a buyer waiting for a big drop after the last cut, you probably haven't seen it yet, and that's why. Meanwhile, the markets are very confident that another cut is coming this month. Futures are pricing in about a 90+% chance of another 25 basis point move in late October. That optimism has sent stocks higher and even pushed gold to new records. But here's the risk. If the upcoming inflation or job numbers come in hotter than expected, that optimism can fade fast. Markets could correct, bond yields could pop higher, and mortgage rates might follow. So while investors are cheering, there's still a lot of fragility under the surface. Think of it this way. The Fed is still debating, the data is uneven, and the markets are acting like everything's already fixed. That disconnect can be dangerous. Here are the key things I'm watching over the next few weeks. Inflation data, the next CPI and PCE releases will tell us if price pressures are really easing. Job reports, we need to see if employment growth is cooling or holding firm. The 10-year Treasury yield, that's the number that most directly affects mortgage pricing. Fed speeches and minutes, listen for any shift in tone or toward pause or accelerate, and of course the government shutdown. With many agencies closed, we might see delays in key data, which makes it harder for the Fed to read the economy accurately. In short, we're flying partly blind for a bit. Here's my personal read on all this. I think we'll likely see one more modest cut later this month, but I wouldn't expect mortgage rates to suddenly fall off a cliff. There's just too much uncertainty in the bond market for that. So if you're a homeowner thinking about refinancing, it's smart to run the numbers now instead of waiting for a perfect world scenario. It just doesn't exist. And if you're buying, focus on flexibility. Choose a structure that lets you adjust later if rates drop. For investors, it's a time for balance. Stay cautious on leverage and don't chase every rally assuming lower rates are guaranteed. So that's where things stand right now. A divided Fed, rising mortgage rates, an optimistic market, and a government shutdown adding just a little bit of chaos. The Fed may be shut down, but I'm not. I'll keep watching these trends and breaking them down so you know what's really happening behind the headlines. If you found this helpful, hit like, subscribe for my next week's update, and drop a comment with your biggest question about rates or the housing market. Thanks for watching, and it's good to be back, and I'll see you next time.